You are welcome. You are welcome to our next chapter on investment appraiser. And this one, we are looking at specific investment decisions. All right. Specific investment decision. Now, under specific investment decisions, we are going to look at two things. Two specific decisions that we would want to make. One of them is lease or buy. Lease or buy. The other one is replacement. All right. So these are the two things that we are going to look at. Let me make sure you are seeing my screen. All right. So these are the two things we are going to cover. But first, let's look at lease or buy. Okay. Now, when we look at lease or buy, our focus here is on the capex. You see, we have been doing investment appraiser, and we start there is a capital expenditure, so we call it the capex, right? Call it the capex. Now, we want to find out whether we should buy the asset ourselves or we should pass through a bank to lease the asset. All right. So look at the situation that I'm giving you. So the buy option. So when I buy the asset, it means that I need to use my cash to buy the asset. So what we need to look for is the cash flows involved when I buy the assets, the cash flow that is involved. The cash flows that is involved. We are looking at relevant cash flows in here. Be very careful. So let me call it the relevant cash flow. All right. So this is it. Now, if I'm buying an asset, here we are doing investment appraiser. If I buy an asset, the first cash flow is the purchase consideration. So the purchase price, what I used to buy. All right. The purchase price, the money that I'm using to buy. So what I'm buying is a relevant cash flow. Understand that. That is that. All right. Now, number two is that if I buy the asset, I own the asset. It becomes my own. And so therefore, another relevant cash flow that can come in is that I will get capital allowance. Don't forget that we've done capital allowance. So it means I'll get capital allowance. And we've done capital allowance. You bought the asset, and capital allowance is the amount given on systematic basis for you to recoup the cost you used to incur an asset, the capital expenditure. All right, so I'll get capital allowance. You got it. Now, number three, sorry, is the fact that I own the asset. It is for me, and therefore I can sell the asset for what? Residual value. So residual value is also a relevant cost. So that is that you have these relevant costs. Number four is that because I own the asset, if there is any repair that has to be done on the asset, I will have to bear the asset. Have you seen that? So here, repairs and maintenance. All right. So these are the four relevant cash flows you can get when you buy the asset. So you'll be doing the present value of these cash flows. All right. Take note of that. Okay. Now, let's look at the lease option. And I need you to understand the lease option very, very, very well. The lease option. Now, here we need to understand the type of lease that we are talking about. All right. We need to understand the type of lease because we are looking at it from finance and tax perspective. Finance and tax perspective. We are not looking at it from accounting perspective, because when it is accounting perspective, IFRS 16 says we should recognize the right of use in the person, but here we need to look at it differently. All right, now this is the finance aspect of the thing. The finance aspect of the thing is that, a lease is actually an agreement between you and a lessee and a lessor to use the lessor's asset for a particular period of time for a consideration. Correct. So you have the right to use the asset for a particular period of time for a consideration. But here, what we are trying to look at is that we are looking at lease in proper perspective, because you don't go A, party A don't go to party B to actually do the leasing of the asset. All right. Here, we are looking at a system where party A goes to a bank. All right. And the bank buys the asset from party, kind of does the leasing or the guaranteeing from the bank. All right. So the bank will actually take this guy's asset. All right. And you go and take the asset, so like from the bank. At the end of the day, the bank settles party B. You will be settling what? The bank. Have you seen how it happens? All right. So basically that is that. Anyway, so let's talk about this. Okay, so we are talking about lease or buy, and I've said there are certain points to note. So the first point we are looking at is that we are not interested in, before I come back to the lease, we are not interested in, the returns that will be coming. No, because you see, the truth is that whether you lease the asset or you buy the asset, hey, you have your capex. And so all the returns you have it because you are using the asset. Either you bought it or you leased it, you'll be using the asset. So all those other cash flows doesn't matter. Your cash inflows, no, it doesn't matter. Those things doesn't matter, because if you lease the asset, you use it to produce the same cash inflows. If you buy the asset, you also use it to produce the same cash inflows. Is that okay? So we are not interested in the inflows, all right, that you'll be getting. So it says here the NPV of the financing cash flow for both options are found and compared. So the lower is selected. So the financing option is our focus here. All right. Because if you are going to buy the asset, you need your own money. You can decide to take a loan from the bank to go and do it. Do you understand? So that is one part. Or you may have the money, you just go straight away, you buy. All right. So here, the financing decision is what we are looking at. All right. So we have the leasing through the banking system. All right. So that is that. All right. So here, the operating cost and revenues are common in each case. Like I explained, it is the same thing in each case. All right. The only relevant cash flow arising as a result of the type of financing is what we want to include in our NPV calculation. So this is where I'm coming to your the leasing. Now, when you lease, here we are looking at operating lease. We are not looking at financing lease. We are looking at the bank taking the asset, you paying the money to the bank, all right, on periodic basis. So in financial reporting, this would have been what? Operating lease. But be careful and read the question. All right. So now, when it is in the lease option, what I will tell you is that be careful of the question. We have operating lease and we have what? Finance lease. Now, the operating lease is the one like your renters, the one that you take somebody's asset, like the way you've rented a room at some place, that every year you will be paying the person. That is how the operating lease is. But so in the operating lease, what you see here is that the asset is not for you. Get it? The asset is not for you. So what will you be doing? The relevant cash flow, therefore, in the Number one, the rent that you'll be paying. So the renters. All right, the renters. That is it. Number two, because you are paying rent and the money is through borrowing, you have tax deductibility of interest. So that is that. Tax deductibility of interest, because it's like a loan thing with you and the bank. So there is tax deductibility of interest. All right. So the money that you are paying as renter is, you will be getting tax savings on it. So tax relief. Number two is tax relief on rental payment. On rental payment. Good. The last thing that you probably have is repairs and maintenance. Because in operating lease, what will happen is that because you just pay, for example, I lived here, community 2021 here. One day I went to work, and when I came back, I stepped on my tire and everything was just broken like that. So I told the landlord, on the weekends, he came to fix everything new. That is there. You have those ones that are there. But imagine, and I'll come to those ones. Imagine that I am in this room and my sink, the pipe is misbehaving or something. Do you think the landlord will come and take care of everything? No. So you see that there are some of the repairs and maintenance you will take care of in this case. So check if there is repairs and maintenance for you to also take care of. Repairs and maintenance. But is the value of the repairs and maintenance here is the same as the value of the repairs and maintenance that is here? You can decide to ignore it because it will knock itself off, because we are going to compare anyway. So if it is the same year, cancel it out. All right. So that is that. Or you can bring it in this one and also bring it in this one. All right. That is that. Okay. So basically, these are the. So somebody will ask. So Tom, what about capital allowance? Now, the thing about operating lease is that the asset is never yours, and I've stated it. The asset is never owned by the company. All right. From the perspective of tax, and like I told you, this is what we are doing. We are looking at it from the perspective of what? Tax, not for financial reporting. And so you may not be facing anything like right of use or whatever. Legalistic. Here we are looking at legal. Does the document prove that it is the asset is for you? So you will not have any ownership in any of this. You will not have any ownership. If the repairs and maintenance is not to be borne by you, ignore it, all right, so that you will be left with only one and two. So that is it. But one thing you must understand is that here you will be paying the repairs and maintenance, all right? You'll be paying, or you'll be paying the lease renter. In my house like this, there's nothing like you have stayed in before the end of the year, then you pay the rent. No, 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 no. They take it advance. So here we'll be looking at doing things in advance. And if you have not watched the video of advanced and delayed perpetuity, then that is a problem. All right. And the rental payment too, you'll be making the rental payment over a period of time. And the tax too, you'll be, all right, getting it over a period of time. And so be also willing to understand that the lease payment or the rental payment that you are doing, all right, you have to apply annuity, because it is the same amount that you will be paying. There is no need to do 10,000, 10,000, 10,000 for 5 years, then do PV, 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 PV. Put it together, one amount, 10,000, find the annuity factor, and boom, you go. All right. So basically, that is that. All right. That is that. Okay. So, like I was saying, whether finance lease or here, we are looking at, because like I said, if it is finance lease, for example, this repairs and maintenance is best suited for the finance lease because the asset is with you, the person. Okay. But in operating lease, usually the owner repairs the thing himself. But like I'm saying, in here, over here, like unlikely for you to get these ones. We will call it a lease. We will not break it down between finance lease or operating lease. But if it is finance lease, usually finance lease, the asset is in your books. Likely for you to also get capital and because of corporate reporting. But here we are saying that we are looking at it from who? The taxman's perspective, legalistic perspective. The asset is not for you. All right. It is not for you. All right. So that will be it. So these are the two cash flows. If you get any question, you should be putting it together and boom, there you go. You have done your lease. All right. So we've done the buying options. We've done everything. Now the last thing for us to do is to talk about, anyway, I've stated here that do not include interest or tax relief arising from them. All right, because here what we are looking at is actually we are not, we are looking at the source of the finance. All right, so there's nothing like interest. These are only your cash flow. All right, these are only your cash flow. All right, so because those ones are dealt inside the cost of capital. You know, the cost of capital is the interest. All right, so the cost, I mean the return on it. So the cost of capital, therefore, that we will use to PV whether this option of that option is the post-tax cost of borrowing. So take note of that, the post-tax cost of borrowing. So if you get the cost of borrowing, then you will do 1 minus t, t being the tax rate. All right, so that is that. Take note of that. And I've put here that note, in some questions you may find that the company is not paying taxes, so pre-tax will be what? Appropriate. All right, even though we are saying use post-tax, when you have a question, a company that is tax exempt, you cannot still use post-tax because they don't pay tax. As simple as this. All right, so let's take a quick look at this example, then I'll go to your revision question, then we will look at that. Now look at this question here. Walsh company already decided to accept a project. So the project is accepted. It's about the considering how to finance it. The asset could be leased over 4 years at a rental of 36,000 per annum, payable at the start of each year. This is the tax rate, and the tax is paid in 1 year in arrears, so delayed. All right, delayed perpetual or delayed annuity. Don't forget that thing that we learned. It's very, very important. Okay, so we use this thing for a practice to learn how to do the leasing. We know how to do capital allowance and those things. All right, so it's just the lease option. Then we go to a major examinable question. Then we crack it out. Then we go to the replacement. All right. So now, let's take this illustration one. All right. So pick out the things that you need. The rental payment. We are told that you'll be paying 36,000 and it is in advance. All right. Most of the papers will always be in advance. Okay. So take note of that. Then your next cash flow will be the tax relief on the rental payment. You know, rent is an allowable expense. Okay. So what will be the tax relief on the tax rate is 30%. Okay. So 36, you have 36,000 multiplied by tax rate is 30%, and that gives you 10,800. So these are your cash flows. All right, these are your cash flows. So this is how you set it up. Lease option. So your years will go like this. Now remember, the rent is paid in advance. So if it is 4 years, what is it? 4 years, it is paid in advance. So you start paying from today. So your 4 years will be counted from year 0 to year 3. That is it. Your year 0 to year 3. You have your cash flows, your discount factor. Then, okay, so usually I tell students that to let the examiner knows what you are about, put in details so that the examiner will just know what you are about. So just here you can put here details. So the details are this. So you have the rental payment that you'll be making, and the cash flow for the rental payment is 36,000 cedis. So put cedis there and put 36,000. These are the rentals that you are going to make. All right. And if you remember your delayed and advanced annuity, you know that every year 0 is represented by 1. So 1 plus, then you will count 1, 2, 3. Annuity. What page are we using? Page 192 is what we are using. So let's come here. Annuity factor. What is the rate? Oh, let's see the rate of the question, the cost of capital of the question. The cost of capital of the question is 10%. So we come here, 10% annuity factor, check, always check the formula first. Annuity factor 10% for how many years? 3 years. Good. 10% for 3 years is here. So 2.487. Good. Meaning that in total is what? 3.487. So if I multiply 36,000 by 3.487, then what I have, so the PV is giving me 125,532. Inflow or outflow? Yes, rent you are paying. So this cash flow is a negative cash flow. It's an outflow. All right. Then tax relief. So let's come here. Let me highlight this for you. The tax relief, check in the question because tax is paid in arrears. We've crossed that bridge already. All right. So if tax is paid in arrears, then it is 4 years. My year 1 profit will be paid in year 2. So my year 2 will be paid in year 3. So instead of 1 to 4 years, it will be 2 to how many years? This is it. Then we told you that if you do an annuity for this is a delayed annuity. You can use how many years? How many years is that? 4 years, but it is delayed by 1 year, right? So 4 years, then the answer that you will get will be at year 1. Then you multiply it back. I hope you remember. So tax relief, the tax relief, it is a relief, it's tax savings, and that one we have 10,800. Inflow or outflow, it is an inflow. That is what you get. It's an allowance given to you. All right, but here, remember what we learned in when we were talking about delayed annuity. We said that looking at this, it means when we PV, the answer that you get will be at year what? Year 1. Then we multiply it back. All right. You can as well decide to do PV this discount factor for annuity for 5 years, 1 to 5 years, up to year 5. So which will give you, for example, it will give you 3.791 for 10 years. So there are 2 ways you can do this. All right. Then you minus 1 year PV from it. So that will be 0.909. What will you get? What will you get? So 3.791 minus 0.909. All right. That gives 2.882. So you can put that one here. Better still, we said that you can use 4-year annuity because from year 2, 3, 4, 5 is 4 years. All right. So annuity for 4 years is 3.170. Is 3.170. Then the answer that you are getting is up to which year? Year 1. And so you PV it 1 year further. Is that not what we said? So 3.170 multiplied by 909. That one too is giving me the same thing, 2.882. So whichever way you will use it, I always prefer this one. All right, but you can also use it. So here will be 2.882. If I multiply 2.882 by 10,800, then I'm getting what? 31123. All right, so this is 25.6, but I've rounded it. So what will be the lease option? The answer here 125532. The answer that I'm getting will be like I have negative 94,406.4, so 406. All right, so basically that is that. All right, and don't forget it. Your answer should always be in negative because we are looking at you sourcing the money, and it should always be in the negative because it will be an outflow, you sourcing the money. So this is it. But if you are using the buying option, then you just have to go ahead and do the capital allowance, all right, for the things that we have learned already. Okay, so basically, this is it. All right, so that is our answer. So just before we go into a pure examinable question, let's look at this illustration. All right, so to help you deal with it. So we have a firm which has decided to acquire a new machine to neutralize the toxic waste product by its refining plant. The machine costs 6.4 million, and the economic useful life is what? 5 years. Tax allowable depreciation is 25%. All right, and reducing balance method is available. So per annum on a reducing balance basis is available for the investment. Tax is 30% payable on operating cash flow, 1 year in arrears. The firm intends to finance this new plan by means of a fixed interest rate loan at a pre-tax. We are pre-tax. So it means we have to make it post-tax, right? Of 10.4. Principal is payable 5 years time. Okay. As an alternative, a leasing company has also proposed to lease over 5 years at 1.42 million payable in advance, scrap value of the machine, and that each financing alternative is 0. So evaluate the two options. Which one is very easy for you to do quickly before they say stop work? It is the lease option, right? It is the lease option. So you have your year, you have your detail, the cash flow. All right. What do you need next? After your cash flow, you need your discount factor. Is that not it? All right. So let me just come here. You need your discount factor. Then you need your PV. That is that. Now, what is the lease option? Leasing company has proposed to lease the thing for 5 years at this place amount. So it means and payable in advance, meaning that you'll be paying how much? 1.42 million for. So everything, let me put everything here in 3 zeros. All right. That means that it is payable in advance. And here you start from year 0 and you end it at what? Year 4. That is for 5 years. All right. So the detail here is the renter that you are paying. And how much is that? It's 1420. All right. I put 0 zeros here. So that is that. Now the discount factor, all right, for that one, we are told that there is pre-tax. And I just told you that whenever you have it, cost of borrowing, you have to do one. So 11.4 into bracket 1 minus t. All right, the tax rate is 30%. So 1 minus t will give us 70%. So what is our discount factor? 0.7 multiplied by 11.4. That is 7.98. So I will take it to be 8%. Okay, so that is that 8%. The 0 is represented by 1. Then I'll count 4 years. So 4 years, 8%. We are at page 193. The table will be given in the exam, so there is no need to prove smart. Go there. This is annuity. We have 8% for 4 years. 8% is 3.312. So 3.312. That means it's 4.312. Don't forget this is an outflow. Okay. So what is that? 1.40 multiplied by 4.312. That is 6123.04. All right. So if you remove the 0 zeros from the thing, you could have made this one 6123.040. Basically, that is that. All right. Then we have your year 1 to we will go back to the question. So you have this 3 point, you picked it from here, 8%, so this is it. All right, and we added our year 0, which is always 1. So let's go back. 193, right? This is it. Okay. So the next one that we have will be the tax relief on tax relief, which is a tax is 0.3 of 1420. That is 426. All right. But how many years are we going to use the asset and therefore the profit that it is going to generate for us? All right. The asset has an estimated useful life of 5 years. All right. Good. That means that this will be 1 to 6. All right. 1 to 6. And as usual, 8%, you do, depending on how you want to do it. Like I say, I prefer using, it is still 5 years in my eyes. So 8% of 5 years, this is it. 3.993. So you can choose to write it like 3.993 multiplied by, all right, what is the PV of year 1? Okay, so that will be 0.926. So multiply by 0.926. You don't understand this thing, it means you've not watched the video on advanced and delayed perpetuity. So 698, 3 decimal place. Or you can decide to pick 6 years here. 8%, which is 4.623. Then you take away 1 year, which is 0.926. All right, you should be getting the same answer. This is 697. All right, but when I did mine, there was approximations behind it. So that is it. Okay, that is it. So I picked this one versus this. So 3.698 multiplied by 426, I guess. So I have 426, 1575.35. So something like this is what I have. All right. But don't forget, this is an outflow and this is an inflow. All right. So ladies and gentlemen, with this minus 6123.04 is 4547.70. All right. So basically that is it. Or 0.6969. Because we are going to compare it with the purchasing option and pick the lower amount. All right. So basically that is that. So let's go back to our page. All right. So basically that is it. So you have this answer that we've had because the figures were rounded. All right. So basically that is that. So that is the NPV for you. So what about the buying option? Buying option. So when we come to the buying option, remember how we set up our capital allowance. So we have T, it depends, is it T1 at T0 or T0 at T1? All right, so T1 at T1 or T0 at T1. I told you that if the examiner is silent on it, then it means it's T0 at T1, where you have tax savings here and you have your timing. Good. So the investment is how much? We are looking at 6.4. So like this. So T1 first, capital allowance is what, 25%, reducing balance. So how much is that going to be for us? So 0.25 multiplied by 6,400. I get 1,006. All right. So 1,006. Quickly, tax rate is 30%, right? Where are you? Where are you? Where are you? Yes, 30%. So multiply this by 0.3, you get the tax savings of 480. Timing, when would that be? That would be T2. Great. All right. So 6,400 minus 1,006, I have 4,800. Don't forget, this thing is for how many years? It's 5 years, all right? So T2, reducing balance, 0.25. That gives me 1,002. Obviously, this will be like 3,600, right? So 1,002 multiplied by 0.30 tax savings, that is 360 at T3. T3 here, the 3,600 that I had, 0.25 again, that is 900. Okay, for 900.3, 270. That will be at where? T4. Okay. So is it 2,500, 2,700 you have? Yeah, 36,900 is 2,700. Yeah, 4. That 2,700 by 0.25. 675 multiplied by 0.3 is 202.5. 0.5, sorry. And that will be at T5. Then the balance here, which is 2,700 minus 675, we have 2,025. So at T5, what is the value of the company, the thing? I told you there is always scrap. There is always scrap. If it is not there, it is what? 0, meaning that here will be 2,025. All right, so 0.3. This is not coming from this video. Watch the previous videos before this, you understand. So this one will be what? T6. All right, so basically that is what you have. All right, that is what you have. Now you can go up and set up your table. All right, so you have your years. Okay, and like I said, here we are not looking at the inflows or anything, but we do know that there will be capex. So what we started with, we do know that the cash flows here, there will be purchase price. So you will buy the thing, there will be capital allowance, there will be residual value, if any, then repairs and maintenance, if any. So now let's set up our table then. So we have year 0, 1, 2, 3, 4, 5, and 6. You know why there is 6? Because of the delay. All right. So now, what do we have? We have our capex, which is 6, 4, and don't forget everything is in thousands. That is that. We don't have residual value, but we have tax savings. Capital allowance, tax savings, which start from which year? Year 2, 480. 480, 360, 270, 202.5, and 607.5. These are not figures that you can annuity them. They are different figures. All right. You can also set up your table vertically. Okay. So that is that. Now, that's the only cash flow. There is no residual value or anything. So you can now PV them. There's nothing you are adding. So you can just bring up your discount factor. Here is 1.00. Then we don't need year 1. We need from year 2 going. So discount factor is what? 8%, right? So here we need discount factor, 8%. Year 2 for 8% is 0.8873, 857, if I see correctly. 857. Next, 0.974, 0.735, 0.708. Then lastly, do I see correctly? 875,94735. No, this one is wrong. This one is a 0.681, then 0.630, if I see correctly. So you have 6,400 here. Let's go. The last one, multiply by 0.650. That is 394.0. 394.88. 202.5 by 0.681. 137.90. 270 by 0.735. 198.45. 360 multiplied by 0.974. 350.64. 480 by 0.857. 411.36. So let's add across everything. Plus 350.64 plus 198.45 plus 137.90 plus 394 0.88. I've forgotten what that is, but let's take it like that. All minus 6,400. All right, so I'm getting a negative. The NPV is equal to 4906.77. There is any difference because of what is here. All right, so basically this one and this, which one is cheaper? This is for, of course, it looks as if the leasing is cheaper, so you go for the leasing. All right, so that is it. All right, so let's go back 193, right? Okay, so you set it up. This is what is here. So the difference probably will come from that roundings that you see. All right, so basically that is it. I think the difference is quite huge, but all figures are the same. 8%. I hope the discount factors are all the same. Okay, this is 794, right? I think so. You can correct it. Okay, so that is that. The writing and my side. 8%. This 794. So here is 794 rather. 0.794, which means this figure will change. All right, so let's say 360 by 0.794, that is 285.44.84. Interesting. All right, so this figure will change slightly, okay, to what you probably have. So 411.36 plus 285.84 plus 198.45 plus 137.90 plus 394 points. That figure there is 88, I guess. All right, all minus 6,400. I guess it's closer now. So 4971.57 is okay. So that is that. That is that. So you can just follow the procedures, all right, and you will get that. Still, it's not there, but anything that happens, I guess this is even 0.3, but I have here to be 0.5. Is it 650? But here is this. So site is a problem. So copy and paste, but you have to be careful, all right, when you are doing it. I guess it's, yeah, it's 30. So it's actually 30. So you can now refer to the figures that are there and you are fine. My interest is that you get your process right. All right. As for the figures copying, I think in the example you pick well. Okay. So 0.83, that would turn this figure to something around what you see here, which is 4984. But at the end of the day, it's still the leasing option. All right. So basically, that is that. Other consideration the examiner usually asks is this. There may be other issues. Who received the residual value of the lease agreement is a question. All right. Is there any restriction associated with you going to the lease company that you may not be able to take additional borrowing elsewhere? All right. So other considerations are there when it comes to the lease. Then you have additional benefits associated with the lease agreement. Who takes the maintenance? Who takes the support service? Like I said. All right. So this is a nice past question. NPV of the lease option, NPV of the, you can do that. The only thing here is that there is repairs and maintenance. All right. So that is that. There is repairs and maintenance of 18,000. So in one of them and the other one, no. So that is that. Okay, so you know what to do from here. All right, now let me go and pick the remedial question or the revision question, this one, because that one has been examined. I am looking for questions that has not been examined yet. All right, so here you have Melanie is considering acquisition of a new machine. All right, and we have I think we saw this one, so I will do that one too separately, how to do replacement. All right, with this same question. Okay, so he said that the new machine could be leased for 3 payments of this payable annually in advance. So you have the lease. Alternatively, could buy the machine at this using a bank loan. Like I said, you can borrow the money at a cost of 8% if the machine is purchased, and you will incur 8,000 per year if you purchase it, payable at the end of each year. The machine would have a residual value of 40,000 at the end of the 3rd year. So with this information, we can do the lease or buy aspect. Then the production manager estimate the maintenance routine. This is another aspect for replacement. Okay, so I will show you how we go by replacement in a different set of videos. So why not do this? You see, if you're able to do this question, then it means that you should be also be able to work this past question that is here. All right, it's the same thing, the same thing, the same thing. All right, so I guess we need to practice what has not been examined so that we will see if it drops in the exam. You have a dito as you see it in this question. Is that not it? All right, so let's look at the lease option. The lease option. What is the lease option? So we have our year. All right, and how many years is this? We are going to pay it over 3 years. So starting in advance, which means every advance or now or today, immediately, all those things will mean that we are doing this thing like this. Detail is our renter. How much are we paying? We are paying 55,000 cedis. Discount factor. The discount factor, we were told that the discount factor is 8%. Okay, so 8%. It is consumed in the discount factor. That is why we don't do interest here, because even the lease option, that is it. So the discount factor is 8%. All right, at the bank, 8%. They didn't tell us whether it is pre-tax or post-tax. All right, so that is that. They didn't tell us anything. But when we are doing the replacement, they want us to use a different rate. But this one, we have 8%. Okay, I think we've done 8% for now. So here, this will be 1 plus 1, 2. Let's go and read 8%. This time around, I need to be very vigilant. Oh, no, it's not. Okay. So this is a different. So in the exams, you'll be given this table, so don't worry. 8% 2 years, 8% 2 years, that is 1.783. That makes it 2.783. So let's do the multiplication. 2.783 multiplied by 55,000. So I'm getting the PV here to be 153. Have we done this before? Perhaps. All right. Then tax is paid in arrears unless otherwise told. So it will start from year 2 to year 4, right? All right. So tax relief. What was our tax percentage in the question? Tax percentage, tax percentage, tax percentage. We are told that tax should be ignored. Taxation should be ignored. All right, that is good for us. All right, and this one is the purchase option. So that makes it a little bit tricky, right? But what do you still have to do? Because you are not given a tax rate, what do you still have to do? Is to put 0, 0, 0. So in effect, we have 153065. That's all. All right, then the capital allowance, we have to go and do, alternatively, we have 160,000 loan from the bank, 8%, incur maintenance per year. The machine will have a residual value of that. We are not giving, so if there is no tax, then you will not get capital allowance because there is no tax for you to. So let's set it up. We are 0. How many years? 1, 2, 3. There will not be 4 because there is no concept of tax. This makes it a little easier, right? So what is the capex? 160,000. No, but there is repairs, right? We need to make a repair of 8,000 per year, payable at the end of each year operation. So here will be 8,000, 8,000, 8,000. Then we have residual value. And since the residual value is not a post-tax residual value, we have to, bring it in. Of course, we are ignoring tax in the first place. Residual value at the end of the 3rd year is 40,000. So here will remain 160, 8,000, 8,000. You can run annuity for these ones. All right. So then this side is what? 48,000. All right, so you can set it up in an annuity form, 1 to 3, so we can do that. Let's go and read discount factors for, so this is net cash flow. Because repair is an expenditure. Discount factor of 8%. Here we go, 1.000, 0.926, 0.857, 0.7, this one again, 794. All right. So I have 8,000. 8,000 is multiplying 0.926. Is that not it? That is 7,408. Then 8,000 again by 0.857. 6,856. 48,000 by 0.794. Is it 48,000? No, it's negating. So let's do the correct thing. So that would be like 32,000 positive. So 32,000 multiplied by 0.794, 25,408 minus 6,856 minus 7,408 minus 160,000. So I have 14,000. This one is far better. This is my NPV. Compared to this, it's negative. Compared to this, then it means that I need to go for the other one, the purchase option, the buy option. All right, so that is that. So ladies and gentlemen, that is what you are going to be doing. All right, so just before we go to the replacement, just one more so that you appreciate everything. Is it 195 by now? Okay, so I mean, look at this past question in August 2022. You have this and this, 15 marks. Okay, so you can have this portion for 15 marks. All right, so you check it, you do this part, then of course there was a service cost 18,000 for all. For each cost that is going to come, there is also a tax benefit. So we didn't do it in this side because there is no tax. So what you need to understand is that for every expenditure that you are doing, there is, so for example, this is the lease aspect. Okay, and the lease aspect didn't have anything like repairs, service cost. All right, so basically this is it. So what you can do is to bring your capex. You start with your capex. All right, then the tax savings thing that you will do on your capital allowance. So this is the tax savings on capital allowance. All right, so these are your tax savings on your capital allowance, and you bring them. Good. Then in the question, you also had this amount. Where is it? 18,000. So this is the borrowing post-tax. All right, so that is that. The amount is 1 million. So this is what you use to do your capital allowance. Then this one, 18,000. Says the annual repairs and maintenance is 18,000. So that is an expenditure that you are going to have. All right. And remember, it is when you are doing capex for these things, this is it. This will be a loss for you because that is the only expenditure. I told you that we don't do income. This will be a loss. And since that is a loss, you will have a tax benefit for that one. So my guess is that this question, you were told that the tax is paid in the same year. That's my guess. Yeah. Corporate tax, yes, in the same year profit is made. So this one is your only loss. So we don't do the income. So this is loss. So the tax will be positive for that. Then we bring in the same thing we do every capital allowance question. All right. Because if you have inflows, you tax. This one, it is negative. Your profit is negative because that's the only thing there. All right. So you tax to have this. All right. And you bring in the others. Basically, that is that. Then you compare with that in your lease. So what I'm seeing here is that it wasn't post-tax. So per the question, they didn't tell you. So the question must actually give you a hint. All right. If it doesn't, and it is just borrowing interest for this per annum, then it means that it is just the borrowing. Then you have to convert it. All right. And because it is FM, sometimes you can say that this is assumed the post-tax is financial management. All right. If questions are not clear, you state your assumption and you move on. So, ladies and gentlemen, that is that. In the next section of the video, I'm going to talk about replacement. And when I do replacement, then I will come and solve the second phase of it, of the replacement. As for questions like discuss this thing, I think you can do it. All right, I think you can do this thing. and other pajan has been solved in the time value of money video, the past question, right? So you can do so. I will teach you replacement, then we will use that one to apply. All right, so basically that is that. So stay put for a part 2 of this decision making.